I'm going to use this video as a means of teaching final accounts at junior certificate level um, today. So we're going to look at a question from your workbook. It's question E from page number 275 of your workbook. I've just put a picture of the question up here. And this is a typical junior certificate type final accounts question. So you're presented with a trial balance for Brace Limited at the end of the year, and in which you have a debit column and a credit column. Now, you'll remember that in the debit column, everything in this debit column has to be either an asset or an expense. So purchases are an expense, interest overdraft is an expense. In fact, all of these are expenses. But then when you get down to premises, fixtures and fittings, vehicles, debtors, those are all assets. An asset, something we own; an expense, something which costs us money. And in the credit column, all of the things in here must be either an income or a liability. So sales is an income, obviously, for the company. It makes us money. But these are liabilities down here. Creditors, people who we owe money to for a purchase. A bank overdraft, we owe the bank €23,000. Issued share capital, we owe our shareholders €120,000, and an 8-year loan, 22,000. Some other important information at the bottom. It tells you that the closing stock is 15,000, and it tells you that depreciation on vehicles is 20%. The vehicles cost us 36,000, as you can see here, so 20% of that is going to be an expense. In fact, these two pieces of information at the bottom, they're going to go in twice into the solution, whereas everything in the trial balance is entered in once. Also, at the very top of the question, you're told what the authorized share capital is. This is how much money the company is allowed to raise through the sale of shares, but of course they have not raised that much. They've only raised 120,000 out of that 850, which is their issued share. So the question is going to appear thus, and we're going to set up the answer as follows. So I'm going to go through the answer now here. I already have it typed out. So you need 3 columns, and you need those the length of the page. And the first step is to calculate your gross profit. So therefore, well, I suppose the first step really is to put in our heading. The heading is Income Statement for Brace Limited for the year ending 31st of December 2018. And you have your money columns, 1, 2, and 3 across here. And the first number is sales. Now, sales goes in the third column, not because of these columns. These columns have no debit or credit aspect to them. It's just that we want this in here because we wish to calculate the cost of sales and then have a clear line of subtraction between these two numbers when we get there. So how do you calculate the cost of sales? Well, that is your opening stock from the question, how much we had at the start of the year, adding on how much stuff we bought during the year, which is our purchases, adding on the fact that we must have imported some of it, so we had to pay customs duty, and we had to get some of it delivered, so we had to pay carriage in. All of that totals to €63,000. You add up those 4 numbers. Then you take away the closing stock, which is in the adjustments outside of the trial balance in the question, and we're told it's 15,000. That is stock which we have at the end of the year, which we did not sell. So you take that away, and that gives you your cost of sales, and then you directly take your cost of sales away from your sales number, and you're going to get a gross profit of €93,000 for Brace Limited. And that's step number 1 completed. Now, then we go on to do the profit and loss aspect of this, which is taking away expenses. Now, you're going to list all of the expenses here. Now, in class, I used to give you guys headings, administration and distribution, which are important for leaving certificate, but I think we're going to leave them out of this particular video. So it's perfectly acceptable that you put all the headings under all the expenses under one heading called less expenses. Now, where did I get all of these expenses? Well, the vast majority of them I got from the question. I'm just going to look back, and I'm going to say that from here downward, so after carriage in and customs duty, which we know we have already used, but from carriage in down, We have carriage out, interest on the overdraft, rent, salaries, and repairs. All of these, 1, 2, 3, 4, 5 of them, are all in the debit column, so therefore they are all expenses. Dividends is also a kind of an expense, but we're going to deal with that in a slightly separate place. So therefore we're going to put all 5 of those directly in, like that. The only one that is separate from that, but that is also an expense, is depreciation of vehicles. That one we had to work out, and that depreciation of vehicles was 20% of the cost of the vehicle. So 36,000 multiplied by 20% gets you 7,200. When you put in all 6 expenses, you total them up to get 80,200, and you bring that number across here and you go gross profit less expenses gives you your net profit. Now that's how much money the company actually make. Now here's where the company run into a bit of difficulty, because of course they have to pay out dividends to their shareholders, and they've actually decided to pay out 15,000 euros worth of dividends, which is more than their profit. That's unusual and surprising for the company, but they've dipped into their bank overdraft in order to do that. So that means that the retained earnings are actually minus 2,200. They've actually made a loss this year after paying dividends of 2,200. You add on last year's reserves or profit and loss balance, which you may be given in the question. And if it's in the credit column, that means it's a profit and you add it on, or an income. But in this question, there was none. So therefore, the profit and loss balance is 2,200 negative. Then you carry that down to page 2. Now, this would typically be the second page of your account. So in here, this is a heading called Statement of Financial Position for Brace Limited. And you start off with your fixed assets and you have cost, depreciation, net book value as your heading. Now, what fixed assets do we have? Well, let's take a quick look back at the question and you'll see that we have 3: premises, fixtures and fittings, and vehicles. Those are 3 assets. We know they're assets because they're in the debit column. And we know debtors is a current asset. So therefore, those 3 are our fixed assets. Depreciation on the vehicles. The other 2 didn't not have it. But if they did, we would have had to calculate it at 10% or 15% or 20% or whatever it might be. And then you subtract the depreciation. So 95 minus 0 gives you 95. 6 minus 0 gives you 6. 36 minus 7,200 gives you 28,800. And then you total up your fixed assets thus. Now, current assets. Less than the only 2 we really can have in junior cert questions, which is bank overdraft and credit loss. That's the answer. How you doing finance by section? Well, you have a long-term loan of 22,000. That's a liability from the question. It's in the credit column. Then you have another long-term liability, which is your issued share capital. You can mention that you have authorized share capital of 850, but that's not really a relevant number. We've actually sold 120,000. And we carry forward our profit and loss balance from the bottom of the first page, which was minus 2,200. Usually that's a plus number, but if it's a minus, it doesn't affect our process. We add that on to get, and when you add up all 3 of those, here I've added these 2 to get 117,800, and then I'm combining now the bank loan with that. When you add up all 3, essentially, you are left with 139,800. And when this 139,800 matches this 139,800, well, then you know that you have balanced your accounts correctly. The chapter after final accounts deals with ratio analysis. I'm just going to have a quick look at that in relation to price limit question. So therefore, you guys can do these accounts after. At any stage, you can pause the video. But here are some of the key ratios that we need to know. And there are 7 of them that we need to know for junior certificate business. So, ratio analysis. The first one is the gross profit percentage, which is gross profit divided by sales multiplied by 100 over 1, which when you do that for this company gives on that we would need to know what it was last year and therefore whether it has increased or decreased. But in general, the gross profit is worth 66% of the overall sales, which is quite healthy. The net profit percentage is the exact same process except with the net profit. 12,800 divided by this gives you a net profit of 9%. Again, it would be good to have last year so we can compare whether that's rising or not. But these are all looking at how profitable. These first 3 are looking at how profitable the company is. Thirdly, the return on capital employed. That is the net profit divided by capital employed. So 12,800 is the net profit on all of the money that has been invested in the company. Now that return on capital employed, the capital employed is the very last number in the account. So of all the money they've put in, they're making 12,800 profit. That is 9.1%, and I'm just going to change that, 9.1%, and that should be your return on investment. So 9.1%. Now, return on investment. Is that good or bad? Well, if you were to bring your money to the bank and try to invest it, you would probably only get about 1%. Investing it in Brace Limited yields 9%. So it is 9 times better than in a bank situation. But of course, there is a risk attached. Now, liability. Liabilities and current assets are compared in the next 2 ratios, which are current ratios and asset test ratios. These measure liquidity of a company. So the current ratio is current assets is to current liabilities, which in this question is 49 is to 39. Now we need to boil that down. Something is to 1. So therefore, if you divide 39 into 49, that will get you 1.26. So therefore it is 1.26 is to 1, which essentially is €1.26 for every €1 that they owe. They have €1.26 with which they can pay. That's okay. However, the ideal is 2 is to 1 in a current ratio, so it's not great. And the asset test ratio is the exact same formula, except it's current assets without closing stock is to current liabilities. So that is the 34. That is 49 current assets minus 15 closing stock gives you the 34. You still put that is to 39, and that is going to be 0.87 is to 1 when you divide 39 into 34. The ideal here should be 1 is to 1. Anything less than that means the company has a liquidity problem. In this situation, the company, for every €1 that they owe, they only have 87 cents with which to pay. So they're going to run out of money unless they resolve that situation. And the last 2, solvency is pretty straightforward. You add up all of your assets, which is your fixed assets and your current assets, to get 178,800. That is the fixed assets of 129,800 and the current assets of 49 combined. And you compare that to all of your current liabilities. The current liabilities are 39 and the long-term liability is 22. That's the loan. So you add the 2 of them to get 61. And you're just comparing, and here, roughly speaking, you can say that the company's assets are about 3 times what the liabilities are. So that's pretty healthy solvency. Means the company is not going to go bankrupt. They own more than they owe. So they own this, and they owe this, and they're in a healthy position there. And finally, gearing. Well, gearing is where you put your debt capital. We're just looking at the finance by section here. So we're just looking at this section of the accounts. And the debt capital is the money which is being borrowed, which in this case is just 22. And the overall capital is 139,800. So you put the 22 over 139,800 and you express that as a percentage. And you can say that of all the money that the company have in the capital employed section, or in the return, the finance by section, they've only borrowed 15%. So this is low gearing. They have not got too many borrowings. Anything beneath 50% is low gearing. Anything above is highly geared. That's a full final accounts question with all the possible ratios and showing you how to do the accounts. And that is from page 275 of your workbook. There are other ones which are exactly the same on page 274 and indeed 275 for you to practice, so you can perfect your strategy on that.